Salut.
Salut. Bonjour, Joël.
Bonjour, André.
Salut, André.
André.
Bonjour, Joël.
Bonjour.
Bonjour, enchanté, Joël.
Enchanté.
Bonjour.
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 Salut, Michael.
Bonjour, enchanté.
Bonjour.
Bonjour, Joël.
André. Enchanté. André.
Bonjour et bienvenue au cadre de Fiscalité. Préférez-vous les instructions en français? Do you prefer the instructions in English?
In English.
Each team has 20 minutes to present its case to the judges. The time is indicated on the timer as a countdown. I will also indicate the time remaining with posters. If you do not end your presentation after 20 minutes, it will be stopped to move on to the period of questions. A period of questions of a maximum duration of 5 minutes is assigned to the jury at the end of the presentation. I would like to remind each judge that it's mandatory to ask at least one question during this period. Please note that you cannot reveal the name or source of your university, as you may be disqualified. I would like to ask the public to turn off the ringing of their cell phone. I will now invite the judges to introduce themselves. Je vais maintenant laisser les juges se présenter et ensuite vous pourrez débuter votre présentation.
Bonjour, Fernand Loisel, je suis planificateur financier, directeur régional pour le bureau de Montréal Centre-Ville IG Gestion de patrimoine.
Bonjour, Julie Racine, je suis coprésidente du comité des jeunes fiscalistes de la Fondation canadienne de fiscalité.
Bonjour, Karine Boucher, directrice en fiscalité chez le Minolet.
Bonjour, Marc Doiron, associé en fiscalité chez le Minolet.
Bonjour, Alexandre Schmidt, directeur de division chez IG Gestion de patrimoine à Moncton.
Bonjour, Michael Bilodeau, je suis directeur régional du bureau de Lévis de IG Gestion de patrimoine.
Bonjour, mon nom est Martin Dionne, planificateur financier, AVA, CPCA, directeur régional pour IG Gestion de patrimoine à Terrebonne.
Being from a dentistry practice, I'm sure you're very familiar with the idea of filling in holes. Whether they be infections in gums or cavities in people's teeth, you need to fill in their holes in order to leave your client satisfied. Similarly, we have been hired here today to fill in many of the tax holes that have been created based on your current tax situation and remedy these and give you the best possible outcome. Hello, my name is Adib Hossein. These are my colleagues Andre Casey and Joël Imon, and we are a part of the Best Accountants LLP, here to solve the Bergeron family's family tax problems in order to best benefit you for your future considerations of retirement and estate planning. So some of the objectives that we have for today include, firstly, tax savings and deferral, created through the efficient tax planning in preparation for the sale that we will display and talk about more in further discussion later on in this presentation. Secondly, another one of our objectives is prepping your business structure to be more efficient for the sale of your business in the near future, as you will be retiring soon, Mr. Bergeron. And lastly, in terms of your retirement, we'll be using young practitioners to enter into your dentistry practice in order to best benefit the continuation of your business, as well as fund your needs for retirement. On our agenda for today, we'll first be talking about the estate planning in relation to your business. Secondly, we'll be moving on to retirement planning for what you can do to maintain funds for yourself and your wife after the sale of your business. And lastly, some general compliance considerations moving forward.
Excellent, thank you, Adib. So to better understand the issues that you're facing as a family and as a corporation, we need to take a look at the current structure in order to create some efficient estate planning. So as for the current structure, we can see that Monsieur Bergeron has complete ownership of Clinique Rock Inc., his dentistry practice, with his 100 Class A shares. He's been operating the business for 28 years, so there's obviously some kind of ownership, so it's closely tied with the family and within the community itself, and obviously it is held closely dearly to his heart, and he wants to assure the prosperity of the business going forward. He is also close to retirement, age 55, and he's planning to sell within the next 5 years. So our current situation, the solutions that we will be presenting will actually take this over a 5-year plan to make sure to make it the most tax efficient possible. There's 2 adult children that are currently studying, and the spouse is in low-income bracket, so we'll make use of that through our analysis. And there is aggressive corporation growth in the past 10 years, and we consider that to be going forward within the near future. As far as one of the questions that you had, and we'll tackle this on very early in our analysis, we're taking a look at the corporate taxes payable for year ended 2018. Obviously, very profitable company and large earnings. So obviously depreciation, and then we'll take some capital cost allowance here for a taxable income of nearly $600,000, which will be taxed with a federal tax payable of almost $65,000. So that will be a liability, obviously right off the bat, that we'll need to assess and to answer that question. So now, as far as the estate planning, so now we're talking a little bit less compliance, a little bit more planification for the future. So for the preparation of the sale of the corporation, obviously there will be some restructuring that will be needed. One of the questions that was answered during one of our meetings with Monsieur was that, is our current structure tax efficient for a sale within the next 5 years? And what we're looking to do now is do a little bit of a restructuration now to make sure that the company is QSBC eligible within future years. So our restructuring objectives that we're taking in place right now for our analysis. Objective 1, we want to attain qualified small business corporation status for the corporation. 2, we want to freeze the value of the company and make sure that any future growth of the value is not taxed in Monsieur's hand, and we can multiply lifetime capital gains exemption through children and spouse and family members. So, as far as the QSBC analysis, Andre will take us over.
So first of all, before getting into the actual qualified small business corporation analysis, we need to know what exactly is a qualified small business corporation. So there's 3 main, I guess, characteristics for a company to be QSBC eligible. So first off, it needs to be a CCPC, so a Canadian-controlled private corporation, which you yourself are as a dentist practice. You need to have owned your share for more than 2 years, which also you have been running the business for past 25 years now, so obviously that is respected. The next condition is that over the past 2 years, 50% of your assets need to be used in order to create active Canadian business income. We did a quick analysis on that. We don't have details here, but we established that that was quite comfortably attained. Where there is usually a problem with the Qualified Small Business Corporation is the third and final necessary point, which 90% of the assets need to be used for active Canadian business income at the time of sale. So the first thing to do for QSBC analysis, we first calculated the goodwill. So we were given the business value, equity value for a price differential of $400,000. The fair market value of your assets, which you gave us, was $1.81 million. And the carrying value of the assets is $1.695 million for a goodwill value of $285,000. Now, it's important to note that while doing this analysis, we need to use the total value of the assets, which are on the balance sheet and also off the balance sheet, such as assets as the self-goodwill. So if we carry on to the QSBC analysis for your current situation. So good assets are the assets that fit the active assets that are used to generate Canadian active business income. So you had cash, accounts receivable, tangible assets, and the goodwill, which we just calculated, which equal around $1.1 million. The total value of the assets are situated around $2 million for the good asset or total asset of 55%. Now, obviously, that's not very close to the 90%, so we first want to take a few steps to get that better. So in order to what we call purify a company, which is to get it QSBC eligible, a first way to do so would be to pay back. So Mr. Bergeron, you would pay yourself back the shareholder loan to the company, since it is not an active asset generating active Canadian business income, and also pay off your liabilities of $18,000. Which will in turn reduce bad assets on the asset side of things. Even after these few adjustments, we're still sitting at around 60%, which again is not close to the 90%. So in order to reach the 90% goal, we made a calculation that around $585,000 of bad assets, and the bad assets that we want to get rid of are your investments, which are in the area of $700,000, since these aren't active business income generating. So we're going to be looking at getting rid of those assets. So without the QSBC eligible business, your taxes on the sale, which would be comprised of simple capital gain, so the sale price minus the value of your shares of $100, would sit around $635,000, which obviously isn't optimal.
Now, in terms of strategies that we can use to mitigate this and achieve that qualified small business corporation status, The first option that we'd like to present to you is dividend in kinding the investments out of the company. So, firstly, Mr. Bergeron, you currently own 100% of the Cleaning Popular shares. And what we would seek to do is dividend in kind the $585,000 of investments, and dividend in kind those back up out to you, so they would leave the company, thereby meeting the 90% criteria rule. So the advantage of this is that, as mentioned, you would meet the Qualified Small Business Corporation criteria, and you would therefore be eligible as a qualified small business. Now, the disadvantages of this is that by dividend in kinding these assets out, you would thereby incur a large dividend that would be taxable to you in the year you receive it, therefore equating to approximately $248,000 in taxes payable on your personal behalf, based on a 42.5% rate on dividends. And this would lead to a total net taxes on the sale of your company of $731,974 after we meet this criteria.
So once again, those are high tax dollars, and we found a way, or a few other options that could actually make this transaction much more efficient. So first option that we established, something called the butterfly transaction. So if we take a look at it, so it basically composed of establishing a family trust, and then paying out a dividend, like you see here, from Kano Group Inc. through the family trust to the corporate beneficiary holding company, which we'll see in implementation how it works. So the advantages of this, it allows the company to obtain QSBC eligibility in a tax-free manner, we could say. Since intercompany dividends are considered between related companies, like we see here through the trust, are actually tax-free. So this would allow to dividend out the investments, make your current company QSBC eligible, and not pay any taxes on getting those dividends out. So you're structured to keep the investment and income splitting possible. If your investment would have some Pubco company shares, you could actually split those incomes through the trust to your children without suffering TOSI rules. Disadvantages, the major one is Rule 55.2. So Rule 55.2 is an anti-avoidance act that was established by the CRA to avoid capital gain stripping and other tax transactions. So this would be quite complicated to do, and there's high legal compliance. It's a very complicated transaction, and much more information would be needed to assure that this could be possible. Basically, it's possible in two ways. If you have safe income attributable to those shares. In this case, Mr. Bergeron with the estate freeze would have the safe income, so that would not qualify for that rule. The second rule is where the butterfly comes in, is if all members of the series of transactions are related, that's where it gets quite complicated, and this is why we established a few disadvantages with the high compliance costs and possible legal costs. So the taxes on the sale with the lifetime capital gains deduction would be approximately $414,000. Now, our last option is, we call it the hybrid estate freeze, so we can dive right into it. So it's kind of similar to the butterfly, but this is more established through 5 years. So basically what's going to happen is we're going to settle a family trust with a corporate beneficiary. So as I mentioned, if the shares have safe income, so safe income is approximately retained earnings, attributable to the specific share. So with the estate freeze, Mr. Bergeron will be receiving preferred shares, which are frozen at that value. The trust will be receiving a common share. So any future growth or any future safe income will be attributable to that new common share. So as safe income rises through that shares, we will actually be able to pay out dividends to the trust and down to the corporate beneficiary on a tax-free manner up to the amount of safe income. So advantages, it allows the company once again to allow the qualified small business in a tax-free manner and structured to keep the investments. Once again, with if you have Pubco investments, you can income split through the trust. Disadvantages, like I mentioned, this is not for immediate, so you would only be able to pay out the dividend kind of the investment as safe income rises through that shares. But since you plan on selling in the next 5 years, we assume that the income will grow at sufficient rates to pay out the proper dividend to reach the QSBC eligible status. So once again, the tax on sale would be approximately $450,000. So now if we look at a quick comparison between the options, So a non-QSBC we established at around $635,000, $731,000 for the dividend in kind, and then $414,000 for the last two options. Now we could go with any of the two last options, but given the complexity of the butterfly transaction, we're going to go with the hybrid estate freeze transaction just because of how complicated the butterfly transaction is. So in terms of implementation of the hybrid estate freeze, so step one would be settling a trust by an unrelated third party. The beneficiaries, obviously you can put anyone in there that you want to give money to, so your children, your wife, along with a corporate beneficiary. This is very important, like we mentioned, for our strategy to pay out dividends through the trust to the corporate beneficiary in a tax-free manner, so that's why the corporate company is there. Step two is the exchange of the Cliniprop common shares, except one common share, and we'll see in a bit why that's the case, for $2,399,000 Class A preferred shares at $1 each. So Mr. Bergeron, you give your shares back to the company, you receive $2,399,000 preferred shares. These shares are non-participating, redeemable, retractable, and super voting. So now the reason why we didn't exchange all the shares is because after this transaction, Mr. Bergeron will have all the preferred shares valued at $1, and the one remaining common share will be sold to the trust. Since all the value of the shares are actually in the preferred shares, the common share has no value, so the trust can buy at basically $1. And what that does is, if you receive an offer for sale, let's say, in the next 2 years, the 2-year rule that I explained to you in the beginning for the QSBC eligible would still be met, since it's actually you yourself holding the share for 2 years or a related party. So we get around this by not exchanging one common share and selling it to the trust for minimal amount. Excuse me. Going on, so as safe income grows, like mentioned, on that common share, we're going to dividend in kind the investment through the trust to the corporate beneficiary in a tax-free manner, given its intercompany dividends between related corporation, and then the trust distributes its dividend to the corporate beneficiary.
Now we're going to take a look at retirement planning. So we want to ensure that you have a comfortable retirement and make sure that you can live the rest of your days financially secure and comfortable. So basically, our retirement objective for your family is assure an efficient sale of the company, and secondly, ensure that you're finally comfortable till the age of 90 years old. So the last thing you want to do when you retire is run out of money before you're passing. So we want to make sure to give you a little bit of leverage to make sure that you have enough money until passing. So basically, this is the proposed structure that we're proposing to your company upon sale within the next 5 years. So it's actually a common industry practice for retiring dentists, and we've done this quite a lot with other clients, is that newly graduated or young practitioner doctors, my apologies, dentists, would actually go along and come in and buy the shares of your company. So it's always kind of a debate within tax, are we doing the sale of asset or the sale of shares? It's very difficult for a dentist to establish himself within a new company. So a lot of times what happens is that a dentist that is retiring will actually come along and sell the shares of his company and retain a certain portion of ownership and control to receive dividends. And then what will happen is, since newly graduated dentists usually do have limited funds to purchase the company, they will actually have a little bit of a break on the selling price of the company to mitigate for those future dividends. So that's what we're proposing here. So basically, as you can see, within the next few years, Mr. Bergeron will take a look at finding new practitioners to take over his company and profit from the goodwill. And basically, he will sell the shares of Cliniprop to those dentists and retain about 10% ownership of the company to receive future dividends of the company. And what we'll be doing as well is we'll be keeping Mr. Bergeron almost as a part-time or almost as an advisor to the new dentist to make sure that his interests are aligned with the company's and make sure the prosperity of the company. So this is a very good way to assure future needs are met. So how do we want to make sure that there is enough money to live another 30 years very comfortably? It would just, we made the analysis here that you can see on the slides, but as for the dividends that will come in and come in net of tax, this is your net income over the next 30 years, and you'll have sufficient funds for 30.41 years, which means you'll be financially secure until the age of 93 for both husband and spouse.
Now, just to go over some of the final considerations and questions that you had asked us, I'd like to address some minor aspects related to your personal use and personal taxes that are applicable to you. So firstly, in terms of the question you had of paying your children a salary, based on the new TOSI rules at the beginning of 2019, adults between the ages of 18 to 25 must work at least 20 hours a week to be eligible for marginal tax rates, otherwise they'd be taxed at the maximum rate. However, TOSI rules do not apply to public company dividends. Therefore, if distributions are given to the children through the trust from public company dividends, they would be taxed at marginal rates on those in order to avoid this. Secondly, in terms of the facelift surgery for Ms. Bergeron, Mr. Bergeron would need to take a shareholder loan of $10,000 to fund the surgery, and if this loan is not paid back within 2 balance sheet dates, it would be included into Mr. Bergeron's personal taxable income in the year it is taken, and there's a deduction available in the year it is paid back. Lastly, in terms of the barbecue and home office expenses are deductible for the proportion of the house used for the home office based on the expenses. For example, any rent, if it was an apartment, or mortgages, things like heat, things of that sort. It would be prorated. A barbecue, however, would not be a deductible expense for a home business due to the fact that it would be used in the business. Now, in terms of the purchase of your cottage, what you can do is actually take out a personal loan to purchase the cottage and then re-leverage it through your business clinic propre in order to be able to deduct interest expenses through the business and maintain ownership of the house. You should consider also contributing the remaining amount to your RRSP contribution room of $125,000 to maximize your eligible deductions. Now, moving on to the last few factors, in terms of land, you have a couple options, being to build a rental property on the land that you purchased years ago or sell it with the business, or you could sell it as is. And we recommend selling it with the business because of the fact that you would be able to, it would be considered a capital property and would be taxed as a capital gain as opposed to a business income, which is currently held as inventory. And lastly, the current shareholder loan has been on the balance sheet for more than 2 dates, and therefore it will be included in your personal income on the year it was taken out, and once you pay it back, it will be removed once more. Now, in order to summarize what we've talked about today, we've created tax deferrals and savings through the use of our structuring through LCGE, lifetime capital gains multiplication, and the savings available. We use the young practitioners and future dividends to fund your retirement and personal attributions, and we believe this will leave you with a whole-free future.
Just a quick question. Is the facelift surgery an admissible medical expense for Mr. Bergeron?
No, it is not. It's a cosmetic surgery, and therefore would be considered a medical expense in any way.
Thank you.
Okay, let's go back to the retirement planning. So how did you come up with the $113,000 income needed for retirement, and what inflation rate did you use, and what return on investment did you use?
So we actually used a 6% inflation rate, but that was based on the 30-year base.
Okay.
So actually the return on investment was 6%, my apologies, and the inflation rate was 2% throughout our calculation. So that's how we went along. And then basically what we did was we averaged it out, because tuition, obviously, which is for the next 2 years for one of the children, and the other one was for the next 4. And then basically inflation comes into that, and travel expenses, of course, of $10,000 per year. So it almost averaged out to $113,000.
And you assume that the dividends will be paid out over 30 years. That's from
the corporation with a 10% interest in the corporation.
Okay.
So we're looking at an average $70,000 dividend per year. After tax basis on that, we'd be looking at around $40,000.
So what's the most tax efficient investment you can have inside your holding corporation?
Inside your holding corporation?
Yeah.
Mostly public companies.
Okay.
And another advantage to that is through the trust you can actually distribute this income through your children. They might not work in the next 5 or 10 years once they get jobs and they get a higher income. But for now, when they have low income, you can income split those public company dividends with the children to benefit from the lower marginal rates.
It's okay.
Thank you.
Thank you.
Thank you.